Futures are pushing higher after the November payrolls report came in hotter than expected. A bit of a better print here. We want to bring in our very own Josh Schafer for more on the market reaction. And Josh, there's so much to dissect and dig into this report. But Maddie and I have been talking for the last 30 or so minutes and focusing in on what we got average hourly earnings and the wages there, what ultimately that's telling us, because that did come in maybe slightly higher than what forecasters have been expecting.
Yeah, so average hourly earnings coming in at 4% year over year. That's unchanged from October. And largely, I think this is a big part of the story, guys, because the narrative coming into this jobs report essentially was if we got about in line print, which I think looking at our screen right now, 227 versus 220, 4.2 versus 4.1 on that unemployment rate, but some had been predicting 4.2. I wouldn't say that's largely unexpected to see unemployment rate come up, but really the narrative was, okay, if we get about an in-line print, CPI is going to matter a lot more to the market next week. And when you look at this consistent wage growth that we're seeing and the fact that that number isn't coming down, and you're talking about this last mile of inflation being sticky, it seems like something we're going to be talking more and more about going into next year. And again, I think it just makes, when we're thinking about what are the risks to this December rally, we kind of just keep talking about stocks are drifting higher every day. Stocks are drifting higher every day to end 24. Well, what could be the risk? It feels like now your risk is probably that CPI print, because it seems like the CPI print would maybe drive, that would be the catalyst to maybe have the Fed not cut in December. It doesn't seem like the jobs report today is moving the needle in terms of that argument, but maybe the inflation print next week does. And even if it doesn't next week, it gets into that whole discussion we've been having about maybe the Fed doesn't cut much in 2025 or at all, right? This wage growth story is a large part of that.
It seems like the market is really running with that 4.2% unemployment rate number as, evidence that the Fed continues to have that justification to cut. And yeah. I wonder how the inflation print, how much that could potentially change that narrative.
Yeah, no, it's an interesting point, Maddie. And the other thing, too, that I'll bring into this conversation from data that was out Wednesday, I was talking to ADP's chief economist, Neil Richardson. She was pointing out to me in their wage data growth right now, so if you took their private wage growth that they're looking at and you looked at CPI, wages are actually only pacing, per their data, about 30 basis points higher than CPI. That's a very narrow margin, right? And so what that means is we talk a lot about, well, at least wages are growing above inflation so the US consumer can keep spending, right? And that's part of why we have this good economy. That margin is actually slimming too, because inflation isn't moving down that much. And at some point, if the general American consumer is barely making more money than the pace of inflation, you wonder about the overall trajectory of the US consumer going into next year. That's a part of this story as well, if inflation doesn't keep coming down and sort of stays in this sticky range. But it does, I think overall, today's report reminds us that while we were talking about the labor market a lot in the summer, inflation seems to be the main print again and the main narrative that we're going to be talking about with the Fed leading into that meeting on December 18th, but also going into next year.
Yeah, Josh, and I think that's such a great point here for investors and for our audience really to understand, because we have been going back and forth just about what print matters most and where investors should be paying close attention to, right? And clearly they both matter, because we wouldn't be having this reoccurring debate every other month just about what we should be paying close attention to. I'm curious, just from your assessment so far, the number of strategists that you talked to, economists, just how they're factoring in the unknown variables at this point when it comes to Trump policy, when it comes to what is likely, the timing of that. Like, how much of that do you think is playing into this narrative, and how policymakers are also trying to figure that out?
Yeah, so when you bring in Trump policy, right, obviously sort of the consensus broad take would be his overall policies, including things like tariffs, are expected to be a little bit more inflationary, right? That's sort of the overall high level take. The question is it inflationary in the first half of 2025, the second half of 2025, or do we not actually see that until 2026? That's one of the hottest debates right now. I don't think anyone really has a good answer because we're not really sure. But I think overall, if that is what leads to the Fed not cutting, that isn't something that people are necessarily worried about for the stock market in 2025 right now. It is, if the Fed is not cutting, because as Jay Powell just said 2 days ago, and I don't think this jobs report would necessarily largely change his opinion, the US economy is in pretty good shape right now. If they're not cutting and the US economy is in pretty good shape and they're waiting for inflation to come down, a lot of people would argue that's still a good opportunity for something like cyclical stocks. That's been a popular call we've been talking about going into 2025, right? Maybe something like financials, one of those sectors. And I think that call still remains whether we get further into this Fed debate about inflation. It seems like that is still something people feel confident going into 2025. But again, the unknown of the Trump policy, Shauna, definitely is the biggest question still looming.
Yes, and it's hard to figure out exactly how, what it's going to look like, obviously. All right, Josh, thanks so much.